Recognition and derecognition guidance. Learning objectives. Understand the role that scope guidance plays in professional research. Understand the conceptual views underlying recognition guidance. Identify the recognition threshold applicable to uncertain tax positions and subsequent events. Apply derecognition guidance to liabilities. Why do we have this lesson? This lesson introduces a sample of the recognition and derecognition issues addressed within the codification. By having exposure to several topics from the codification and practice applying guidance to sample recognition issues, you'll become a more experienced researcher. And of course, this does take time. Examples. This lesson will touch on issues associated with uncertain tax positions, subsequent events, derecognition, liability extinguishments. As we discuss recognition issues, notice the different recognition thresholds in each topic. Recognition describes what, when, and how an item should be recorded in the financial statements. This is covered in Section 25. Notably, the Other Presentation Matters, Section 45, often gives additional guidance on how to record an item. Derecognition, Section 40, describes when and how an item should be removed from the financial statements. Notably, items can also be removed from the balance sheet through other means, for example through amortization or impairments. These are generally described as subsequent measurement issues. Let's look at the conceptual framework views on recognition. Con 5, Recognition and Measurement, cites 4 fundamental recognition criteria: definitions, measurability, relevance, and reliability. Items meeting these criteria should be recorded subject to both cost-benefit constraints and materiality. The FASB does not consider disclosure to be an adequate substitute for recognition. Now let's look at uncertain tax position. Reporting deferred tax assets and liabilities in the financial statements can involve judgment. ASC 740-10 Income Taxes establishes a 2-step process for the recognition of tax positions. Determine whether a tax position meets the more likely than not recognition threshold. Then, if met, determine the appropriate measurement of the tax position. Applying the more likely than not condition involves consideration of several factors, and see paragraph 25-7. Subsequent events recognition. A subsequent event, ASC 855, is an event that takes place after the balance sheet date but before financial statements are issued. This is located under the broad transaction area. So you can see this is a fiscal year ended 12/31/14, and the financial statements are issued 2/27/15, so that represents the subsequent events period. There are 2 types of subsequent events. First, recognized subsequent events, type 1, provide additional evidence about conditions existing at the balance sheet date, including estimates inherent in preparing the financial statements. These require adjustment to the financial statements. Next, type 2, unrecognized subsequent events, provide evidence about conditions that did not exist at the balance sheet date but arose subsequent to that date. These do not require adjustment to the financial statements. However, these may require disclosure to keep the financial statements from being misleading. So what was the recognition threshold for a subsequent event? Recognize if the condition existed at the balance sheet date. Now let's look at derecognition and look at liability extinguishments. ASC 405-20, Extinguishments of Liabilities, provides guidance on when it is appropriate to derecognize a liability. Acceptable methods generally include the debtor pays the creditor and is relieved of the obligation, or the debtor is legally released from being the primary obligor under the liability, either judicially or by the creditor. ASC 470-50, Debt Modifications and Extinguishments, applies these broad liability extinguishment principles to debt instruments.